Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 345 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including where the U.S. dollar is headed, how bear markets usually start, the downsides of private investments, and some of the latest economic data. Whether you're tuning in for market insights, planning tips, or just staying informed, there is something here for you. So, what is going on, Matthew?
Well, not much. You know, when I was preparing for the podcast today, I feel like I've been sharing a lot of data on the market itself. So I have a little bit of a different slant today that I'm going to look at the lens of the stock market in relation to the economy. So I got a fresh perspective today. What about you?
No, everything's good. Just trying to keep up with the news and, ever-changing headlines. It seems like things just keep going quicker and quicker as I continue to get older in terms of, geopolitical events changing so fast.
Yep.
But no, other than that, just trying to wish some consistent warm weather in the Dayton area.
I know, it's been
yo-yoing
weird.
Back and forth, which is pretty frustrating.
It is.
Other than that, life is good.
All right. Well, let's dig into it. And we got a lot of good content. Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today.
So as always, we will review the month-to-date and year-to-date performance of the major market indices that investors track. This data is from Y-Charts and as of the market close on April 6th. S&P 500 index is up 1.3% so far in April and down 3.4% on the year. Dow Jones Industrial Average up 0.7% for the month, down 2.9% for the year. NASDAQ Composite Index up 1.9% for the month, down 5.4% for the year. The Russell 2000 Small Cap Index up 1.8% for the month and up 2.5% for the year. And the Vanguard All World X United States Fund is up 1.2% for the month and up 3.3% on the year. 3-month Treasury rate at 3.72%, the 2-year at 3.84%, and the 10-year at 4.34%. So moving on to big headlines, current events from the past week. News broke last Thursday during the trading day, Matt, that Iran was coming to the table to open up the Strait of Hormuz to a certain extent, which made markets pop. But then Trump's deadline for Iran to open up the strait was yesterday, but might have kind of gotten moved to tonight at 8 o'clock. He was expected to give a press conference today. Don't think that's going to happen, at least during the day, possibly later tonight. And as of this morning, it looks like the U.S. hit more military targets in Iran. So, again, like I was kind of alluding to earlier, things just change so quickly and deadlines change overnight when you're sleeping. And it's kind of hard to keep track of all of this.
Yeah, I kind of come at it from this perspective. There's so many potential off ramps for both sides that, I would be careful for investors to try to time these geopolitical headlines. It's not a game that is going to be fruitful.
No, I would agree. So I'm sure we will get a lot of new information over the coming week, which obviously we will cover next week if it's pertinent.
Well said.
Moving on to tweets, articles, and research from this week. First thing I had was a newsletter from the chart report on March 28th. and it talks about the U.S. dollar and the U.S. dollar's performance in relation to Trump's first term.
Yes.
So Jenna will throw up a chart for viewers on YouTube. It'll also be in our show notes, but what you're going to see is there's a blue line in the top portion of the graph that shows the U.S. dollar's performance during Trump's first term, and then the second line, the lower half of the graph, shows the performance of the U.S. dollar up until this point of Trump's second term. And what you're going to see very, very clearly, Matt, is that the pattern of the U.S. dollar in Trump's second term is almost identical.
It's almost perfectly correlated.
Right? So, again, does this mean the U.S. dollar will follow it for the next several years? It's anyone's guess, but up until this point, it's been pretty similar. And I just wanted to share some commentary from the chart report. They say the U.S. dollar index is so far tracking closely with its performance during Trump's first term. These analogs aren't meant to be followed blindly, but they do provide useful context for how trends unfolded the first time around. Year one saw dollar weakness, which we experienced last year. Now in year two, the dollar appears to be carving out a bottom and mirroring the prior cycle. If this analog continues to hold, it suggests a setup for a rally into year end with strength extending throughout next year. So what that could potentially mean, if we do get a stronger dollar, over history in general, I'm not even going to talk about, U.S. stocks versus international stocks, but typically a stronger dollar, stocks tend to be a little weaker than they would under a weaker dollar, for lack of a better term.
Especially for international, right? So as that dollar strengthens, that becomes, a headwind.
Yeah, it does. It does, pretty clearly. So it's going to be interesting to see how this plays out, but it's not like a perfect 1.0 correlation, right? We've seen instances where stocks have been strong in strong dollar environments, and we've seen instances where stocks have been strong in weak dollar environments. But again, I'd
categorize it this way. I'd say if you got that headwind, right, and you're heavy on international stocks because they've been in favor the past year, I'm not saying the international stocks are now going to be underperforming dramatically. You just now all of a sudden have a major headwind.
Right.
I think it's just, I want you to acknowledge, just like we had to acknowledge when the Fed was doing, the quantitative tightening up until December of last year for 3 years, that was a headwind for the market.
Right.
International investors are right now, people who are overweight international stocks are thinking, hey, this is an easy trade. I'm making money hand over fist compared to, U.S. equities. You now got a major headwind.
Yeah,
if this trend continues.
Right. Because if you have a stronger dollar, those companies that are generating revenue overseas, it's worth less when you translate it back. And if you just look at the U.S. dollar's performance in 2025, virtually was a straight decline.
Yes.
Without any major rallies to the upside. And
tailwind.
And what happened last year, international significantly outperformed the U.S. So
just saying, just be careful that history repeats itself. You're going to have a headwind.
Right. So second thing I had was a blog post from Ryan Dietrich at Carson Investment Research on April 1st. So this is a legit post. It was not an April Fool's Day joke. And just wanted to share a brief section of his blog post. So Ryan says, the S&P 500 peaked on January 27th, and it was not down 5% until March 18th. Some 7 weeks later. I was watching CNBC yesterday and I saw my friend Sam Stovall, CFRA's U.S. equity strategist, who noted that a bear market has never started when it took so long for the initial 5% mild pullback to occur.
Ooh, interesting point.
I dug in and found similar results using trading days. This time it took 35 days to be down 5%, and the previous 11 bear markets saw things down 5% in less than 15 days. In other words, at the start of a bear market, it typically takes about 3 weeks to be down 5%, but this time it took 7 weeks to get there. The longest initial down 5% to then move into a bear market, you may ask? 24 trading days in late 1968. The bottom line, bear markets tend to start off with a bang, and the action so far simply doesn't fit. So
that's a great point. I mean, I didn't think of it from that lens, Mark. That's a great point to throw out there.
Yeah, I think it is too. I thought it was very interesting. I did not know that before reading this article, so I just wanted to throw that out there that, usually bear markets are weak right off the bat very quickly, and it hasn't happened up until this point. So
why don't you take 30 seconds, explain the difference between what a correction is and what a bear market is?
Yeah, correction in the industry is categorized as being 10% off of a all-time high, and bear market 20% off of an all-time high. So,
thank you, sir.
We've been in correction territory now. Obviously, have not hit bear market territory, and it doesn't necessarily mean that we're going to get there. And I think this data shows that.
Love that.
Last but not least. Got an article from the Wall Street Journal on April 2nd titled "Blue Owl Investors Seek to Pull $5.4 Billion from Two Private Credit Funds" by Matt Wers. So just wanted to read a little bit of this, but I think, private investments have been a pretty big topic of conversation over the past couple of years, Matt, and, not patting ourselves on the back, but
pat ourselves on the back.
The biggest issues that we have with private investments and that we've had is the illiquidity factor, and that's kind of exactly what's happening right now. So,
but let's take it one step further. For the past decade, the popularity of these private investments, I think you would agree with this statement, they've gone up in popularity a lot over the past decade, right? And I want to throw this out there for listeners and viewers. Mark and I have been together at certain industry gatherings where these conversations come up. And it's funny how we are around individuals that manage similar amounts of wealth for others. They run wealth management practices. And, the conversation comes up about private investments, and, it's either me or Mark might beat me to it. We usually bring up the topic of liquidity. And, the topic comes up and it's like, oh, Matt, you're just thinking that this is, 2008. This is not going to be 2008. These funds are going to have plenty of liquidity. And usually Mark looks at me, I look at Mark, and we kind of have this acknowledgement that we know better, that liquidity is not a problem until when, Mark?
Until it's a problem.
Until it's a problem. And when by the time the house is on fire, you're in a lot of trouble.
Right.
And I just want to throw it out there that people just don't realize that once liquidity becomes the problem, you could have your money tied up in this, and it could be a self-fulfilling prophecy that you might not see your money for literally years. And it's not respected enough. Until you get bit by this, you don't fully get it.
Right.
That makes sense?
And I think it's all, based on what the client's situation is. If you have someone that's worth $250 million and they want to put $5 million in a private fund that, most likely they're not going to need
for a decade.
Or want for a decade, then sure, it makes sense. I think just the reality of it is the clients that we serve are not that type of client, right?
Yeah, exactly.
And,
that's well said.
You need to have access to this, right?
You do.
So they said that investors in two of Blue Owl Capital's biggest private credit funds asked to pull out some $5.4 billion in the first quarter, adding to the growing stream of capital leaving the once hot corner of Wall Street. So just for listeners, education purposes, a private credit fund is an investment fund that lends money directly to companies instead of buying publicly traded bonds. So you could go out there and buy, debt from Apple or Amazon or Microsoft or Google and get paid an interest rate. So it's the same concept, but it's just lending directly to private companies, right?
Yeah, you're hiring a manager who's doing the underwriting, doing the credit analysis, loaning that money out, making sure they get paid back. There's no guarantee on that, et cetera, et cetera.
They said the redemptions amounted to 22% of Blue Owl Capital's giant $36 billion private credit fund and 41% of a separate technology-focused fund. Blue Owl opted to cap redemptions in both funds at 5%, a reversal from its decision in January, allowing shareholders to redeem 15% from the technology fund. Curbing investor withdrawals comes at a delicate time because investment firms and the Trump administration are pushing to include private credit and private equity in 401k savings plans.
Which we talked about in this podcast.
We did.
And we talked about how I was against it. You were against it.
Yeah. And I think the thing maybe that some people don't realize or just don't fully appreciate when they're getting into these private credit funds is, they see the yield on the fund of 10 or 15% per year, but they don't see that, a company like Blue Owl has the right in those documents to cap redemptions at a certain percentage or to not give redemptions. Right?
Correct, sir.
So when you find yourself in this situation where you're looking to have a private investment be a part of the portfolio, you have to go into it thinking that I cannot access this money for X amount of years, whatever the lifetime of the fund is, right? Mm-hmm. So any other thoughts?
I mean, if you look at the stock market, let's just compare it real quick. The disadvantage of the stock market when you're comparing it to private investments is the whole mark-to-market valued by the last trade philosophy, right? And I feel that stocks over the past decade, just up until recently in this comparison topic, have gotten this liquidity discount because it's like they're so volatile week to week, month to month that we're going to give a discount to stocks in comparison to private investments. And then all of a sudden, you rinse and repeat. These things, rhyme. We're now going through, let's call it a private equity liquidity crunch. And all of a sudden, stocks don't look that bad. And having daily liquidity is just so underrated until you have a liquidity problem. And then when it hits you front and center, I'll give you an example. There's some pension funds out there, and there are endowments that literally are having to go out and borrow money right now. I mean, have you seen these headlines?
Yeah.
How do you have an Ivy League college overweight in private equity so heavy that they have to go out and borrow money? Give me a break.
Yeah. Yeah. It's not a good situation when, like you said, when liquidity dries up. So I'll turn it over to you. We wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock.
All right. So I want to focus on a little different topic about underlying economic data. Mark, my first chart is from Top Down Charts on April 4th. We've had the gentleman who runs Top Down Charts on the podcast in the past.
In the early days.
Early days, baby. He was down. I think he's still down there. I think he was in New Zealand. We had to really work on that.
You're right.
We had to work on that time change.
Yeah.
He had a postmark about U.S. economic confidence. So this is what he had. Jenna will put up this chart for our YouTube viewers. This will definitely be in our show notes. This is what was written. Economic sentiment. Meanwhile, the combined surveys, 7 surveys, the economic sentiment signal is net optimistic and trending higher. This is a positive sign for the bulls. Basically, it says the economy is doing fine and markets are doing their usual greed to fear oscillations, end quote. The subcomponents of this chart, Mark, are the following. The NFIB small business, consumer confidence, manufacturing PMI, NAHB, Philly Fed, TIPP economic optimism, and non-manufacturing PMI. It shows all those 7 charts, and then what it does is it overlays the composite with equal weighting. And what you're generally seeing is economic, the sentiment is actually on the upswing, despite the geopolitical headlines in recent time. Just want to throw it out there that underneath the surface, from an economic side, things aren't necessarily horrible. I'll continue. My second piece has to do with an analogy that Bank of America's market strategist Hartnett came up with, and it compares the Fed funds rate versus the percentage of individuals who are quitting their job. Now, when I saw this chart initially, I had to take a second look. Who goes as far out to find correlation between people quitting jobs and the Fed funds? That correlation was not on my radar. Was it yours?
No,
Okay.
no, not at all.
So this is a new one for me too.
Yeah.
It is for you.
It would be fun to have your job be defined, these new interesting correlations.
Yeah, define what's the next correlation no one's talking about.
Right.
Okay.
Great.
So this is my prepared notes. So the Bank of America strategist Mike Hartnett is pointing out that quit rates, that's the share of people who are voluntarily leaving their jobs, is still a reliable signal that the Federal Reserve will keep cutting interest rates rather than raising them. Right now, the rate is low, and history shows low quit rate levels have usually lined up with easier Federal Reserve policy in the future. This post also notes that we could make the same exact point with the hiring rate, which has also dropped sharply and points to a little bit of a cooling job market. All this suggests that the labor market is softening enough that the Fed probably doesn't need to hike rates anytime soon. We'll put this chart in our show notes, but why am I highlighting this? Well, with the recent geopolitical headlines, you have seen oil move higher. It has pressed the concern that inflation might reignite if oil stays above $100 a barrel for an extended period of time. In doing so, it has pushed out now the expectation of when we're going to get the next Federal Reserve rate cut. Now let's go back to the top of the podcast. As you were discussing the volatility in the geopolitical headlines, kind of fits and starts the past couple of weeks, what happens if there is some sort of bigger truce negotiation deal and all of a sudden the premium on that oil price comes in? You're probably going to see the 10-year yield come in. You're probably going to see inflation expectations start to come down. And all of a sudden, the conversation over the summer is going to be about what? What is going to be the path of Federal Reserve interest rate cuts? Just like we were talking about it before the geopolitical headlines. So I'm going to be a forecaster, okay? We're in a midterm election year. I think it would be naive to think that this administration is going to do a long, drawn-out conflict. Is it a possibility? Of course it is. But the plan A, the most likely path, is something that is shorter in nature. They don't want oil at $100 a barrel plus going into the midterm election. Let's say oil comes in by the summer. It's more reasonable. It's under $100 a barrel. You watch, conversation's going to be all about the Fed again.
Yeah, it's a good point. And, I think this is an interesting chart because, the U.S. quit rate seems to be a leading indicator of where the interest rates are going to go. So if you think, back to the early 2000s, the quit rate was rising in like 03, 04. Interest rates started rising in 04, 05. And then, in 08, 09, quit rate was coming down. Shortly after that, interest rates came down.
Yep.
And then, so on and so forth. And what you're seeing right now is that starting in, 2021, 2022, when the quit rate peaked and has come down and rates were still rising, that was a sign looking back and playing Monday morning quarterback that, we were going to be in a falling rate environment sometime in the next couple of years. And that's exactly what we're seeing. So
well said.
Yeah, interesting.
My other goal now is to find more obscure analogies and correlations of different data points. I'm going to try to see if I can catch you in the next month or two with just another obscure one that you're like, Matt, where are you coming up with this research?
Yeah, I would love it. I wish I had more time on my hands to do the same thing.
I'm going to go out of my way to find these things now. My last piece has to do with short interest being very high. And the reason I want to point this out is this, my message to our listeners and viewers, Mark, this is not a market that I want you to try to time on a short-term basis. All it takes is a couple of headlines. And in theory, with what I'm about to tell you here in a second, this market could literally rip 3, 4, 5% in a day. Okay? So my piece has to do with a post I've seen from Global Markets Investor. Jenna will put up this chart for our YouTube viewers who are watching this by video. This will be in our show notes for our traditional podcast listeners. And as a reminder, all of our show notes can be seen on our popular social media sites, everything from a LinkedIn to a Facebook to an Instagram to an X, etc. So this great post highlights something called short interest, Mark. It's a bunch of investors who've been betting against U.S. stocks by shorting them. That's basically borrowing shares, selling them now, and hoping to buy them back cheaper at a later date. Right now, the short interest is at some of the highest levels in over a decade across the big indices. Right now, 3.7% for the S&P 500. That's the highest in 11 years. 2.7% for the NASDAQ 100. That's highest in 6 years. And 5% for the Russell 2000 Small Cap Index. That's the highest in 15 years. It's climbed sharply, you're going to see by the chart, since mid-2024. The last time all three were this high at once was back during the 2010-2011 European debt crisis. Bottom line, there's tons of fuel for a potential short squeeze if stocks start rallying hard. Short sellers could get squeezed, forcing them to buy back shares, pushing prices up even more. Your comments?
Yeah, I think the best way, or I guess the easiest way to think about this is, short sellers, all they are future buyers. So at some point, they have to buy to cover and close out their position, right?
Yep.
And it's just one of those things. It's like, how much pain can you tolerate? But once you get, a few of those big short sellers starting to cover their positions and they're turning into buyers that push prices up, that's when you can get that squeeze. And then people are panicking to go and cover their short positions to buy, right?
Yep.
Because
and you got to think
hypothetically, the losses are unlimited to them if they hold on to their short positions.
That's right, because that stock can go up more than about 100%, right?
Right.
The other aspect is buying the shares back initially just gets them neutral. Let's say they want to get long. They got to buy twice.
Right.
They got to buy one share just to get back to close out the short,
and then to
and another share
long
if they want to get long.
Right.
I just want to throw it out there that a lot of negative positioning, and I know I highlighted it on the podcast last week, so I won't revisit that. I would encourage, if you didn't listen to last week's podcast, 344, to definitely check it out because I highlighted that. But just a lot of stats are telling me that this market is a powder keg right now with potential if there is more of some clarity on the geopolitical front in the next week or two.
Yeah. Yeah. Well said. Well said. Well, we're going to leave it there for this week. I just want to thank everybody for listening to episode 345 of the Independent Advisors podcast. We will be with you next week for episode 346.
See you next week, everyone.
Thank you for listening to the Independent Advisors podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Facebook, Twitter, LinkedIn, and X. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.